Good riddance 2022. Live from New York City this morning. Good morning, good morning. Equity futures positive by 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. Hello, 2023. Leaving behind the worst year since '08. China's reopening push injecting a fresh dose of hope as Wall Street economists line up to forecast recession.
Recession. Genuine recession.
In terms of, the recessionary outlook.
The likelihood of a recession.
Will we have a recession? When will it be? How deep and long lasting might it be?
Risk of recession is certainly something that we're very focused on.
Fundamentally speaking, we do expect 2023 to be, worse than 2022.
The leading economic indicators are negative.
Growth will undeniably slow.
The yield curve is pricing in recession.
Most likely a recession in 2023.
The economy is flirting with a recession.
The good thing is that it's not the end of the world.
Happy New Year.
Happy New Year indeed. A fantastic way to kick off the year with SocGen's Subhadra Japa and Morgan Stanley's Jim Karen. A happy new year to both of you. Let's kick things off with this. Subhadra, is it too early to switch our attention from inflation to growth?
I think so. For the most part, if you look at the data that we've been getting for the last quarter and the data we're expecting over the upcoming quarter, I think for the most part, the economy is going to be relatively strong. I don't really see any clear signs of a recession. So for the most part, from my perch, I feel like the market being so concerned about a recession so soon in the year seems like it's a little bit overdone. There's definitely more potential for inflation to come down gradually, but really the end point of inflation is still going to be a lot higher than people expect. So under the circumstances, I think the Fed is going to be very much on track to continue to raise rates for the remainder of this year. So, I think that the recession fears, at least in my view, feel like it's a little bit too overdone.
Jim Karen, do you agree?
Two-sided at this point. And the way I look at it is that we're at the point in the cycle where mistakes are commonly made. We're late in the tightening cycle. This is when if a mistake is made, it tends to be amplified. So if we get a slowdown and if it's a bumpy landing or a soft landing, I'm okay with that. But if we get something more, if the Fed overdoes it with the tightening cycle, this could create a more devastating situation for assets. But on the other side of this, if the Fed doesn't do enough, it also means that inflation becomes unanchored, starts to rise, and then the Fed has to restart their hiking cycle, and that could be a problem for asset prices down the road as well. So the way I look at this is that there are two very fat tail risks that are out there. One is that inflation, goes down and it comes down and asset prices rally a lot and people miss the rally and they have to chase higher prices. And that could create, problems in and of itself. And the other is that we do get a much more severe slowdown than what's being thought of. Right now, consensus is that about 2/3 of economists are forecasting a recession, but it's most likely a mild recession. So that puts us somewhere in the middle of capturing yields and earning carry in an environment where the Fed maybe ends their policy hiking cycle somewhere between 5 and 5 1/4. And again, that's consensus.
Well, Jim, let's pick up on what Subhadra was talking about. Let's talk about what we see right now. Where do you look for signal that we're experiencing a real profound slowdown that will ultimately lead to a recession?
I think we have to look at the labor market. For me, the labor market is really the linchpin. It's all about inflation. And when I say inflation, I really mean it's the service sector inflation, and wages and labor is what's feeding into the service sector inflation. So if we get a slowdown, it means that the unemployment rate has to rise. If we get the unemployment rate rising up towards 4.5 to 4.7%, so say about 1% higher than where we are today, that's going to represent about 1.5 million losses of jobs in the labor market. So if there is that type of a slowdown, I think it's manageable. Certainly, it's not great. We need wage inflation to come down to about the 3% level for it to be more stable, for the Fed to reach their inflation goals and their targets. So the signal for me is going to be a modest slowing of the labor market that gets wage inflation under control, that ultimately lowers service sector inflation, and that keeps inflation more durably lower and keeps inflation anchored. That's what we need to see. If we don't see that, then I think we have a bigger problem.
Subhadra, is there any evidence whatsoever that that story is developing?
Not really. I mean, we're looking at this week's employment picture, another 200,000 jobs expected to be created. The unemployment rate is at 3.7%. Wages are around 5%. Like Jim was saying, what we really need to see is that unemployment rate rise from 3.7% to 4.5%. And that's going to be harder than people expect, given how tight the labor market is. You're looking at the JOLTS job openings. You still have roughly about 1 million jobs. 1.7 job openings for every person that's unemployed. So, for the most part, you look at every metric. Labor market differentials in the Conference Board data. Every metric suggests that the job market's extraordinarily tight. So, nudging that unemployment rate from 3.7% to 4.5% is going to be a lot harder than people expect. And if the unemployment rate is still low and sticky, and the job market's relatively robust, the Fed is going to continue to try to keep policy, quite restrictive for the remainder of the year.
More data this week. Payrolls on Friday. CPI coming next week. That's a busy Mike McKee. Mike joins us now. Morning, Mike.
Good morning, John, and you're right. This is starting off 2023 at a sprint rather than a work your way into it kind of year, because we have an awful lot of data that will matter to the Fed, and that's what matters to the markets. You take a look at the calendar. We just have this S&P manufacturing PMI today, but tomorrow we get ISM manufacturing, and we'll be looking there at prices in particular. JOLTS, as Subhadra mentioned, is exactly what Jay Powell has been hanging a lot of Fed policy on, so that will matter. You get the Fed minutes on Wednesday. What do they think is going to happen to the labor market? More jobs numbers on Thursday, and then we get on Friday the jobs numbers for December, and it's going to be very interesting to see what happens. The numbers that we're going to be watching over the course of this week are going to be those ISM numbers, because we want to see whether the economy is starting to really contract, and then prices paid. They've been dropping significantly, but those are goods prices. And then employment still 200,000, 3.7, and hourly earnings still at a strong 0.4. The question there is, are we really forecasting at this point, or are we just guessing because the economy has stayed so much stronger, the labor market, than we thought? And then this is what everybody's going to be watching in 2023. This is from the WIRP function on the Bloomberg. You can see that markets at this point expect the Fed to peak in the May and June region at about 5% and then start cutting rates. The Fed doesn't see it that way. There are no rate cuts in their forecast for the year. So we'll watch and see how that changes as the year goes on and the data come in.
Someone's going to be very wrong, that's for sure. Mike, wonderful to have you back, sir. Happy New Year to you. Just a quick look at equity futures right now on the S&P 500, elevated through most of this morning, about 23 minutes away from the opening bow. Futures right now up 5 or 0.6%. If you check out the bond market, we've had a rally all morning. Yields down across the curve, 2s all the way out to 30s. Your 10-year down by something like 10 basis points. Your 2-year right now is down about 6 basis points to 374, down 13 on a 10-year at the moment. I want to come back to you, Subhadra Rajappa, on this call in the bond market now. If you believe that maybe this economy is stronger than people are describing it coming into 2023, tell me where that leaves your call on this bond market through this year.
So I think that right now, 10-year yields where they are look quite rich to me. I feel like there's still the possibility for another leg lower, higher in yields, lower in price in the first quarter of this year. You're looking at an ECB that's really playing catch up. I mean, our economists have the ECB at 3.75% as a terminal rate. In the U.S. as well, I think the market is underpricing, as Mike was pointing out, the pace of hikes. I mean, the Fed has in its own dot plot an expectation for the Fed funds rate to get between 5 and 5.25, and the market's pricing a terminal Fed funds rate that's lower than that. Not only is it doing that, it's also starting to price in cuts for later on this year. So none of this actually really makes a whole lot of sense to me. I feel like there is a momentum towards perhaps modestly higher yields in the first first quarter. You're going to get a decent amount of supply from the corporate sector. You're also going to get the ECB raising rates, QT coming from the ECB. So broadly speaking, I think the trend is going to be towards modestly higher yields in the first quarter, maybe in the first half as well. Beyond that is when we see the potential for 10-year yields or Treasury yields in general to start declining, and the 10-year yield ending the year around 3.25%. Why? Because the Fed is going to keep policy restrictive for the remainder of this year. They're not going to be rushed to cut rates if the economy slows down, given how high inflation is expected to be at the end of the year.
Subhadra, you mentioned the corporate supply, $40 billion in US investment-grade market supply expected this week alone. The stat that came from the team here at Bloomberg, that's more than 4 times the volume for a whole of December just a month ago. That was a very, very quiet December. Jim, I'd love your thoughts on what Subhadra just said on this bond market. There are so many people coming into this year saying recession for 23, bonds are back, I want to own fixed income. I'm looking at some of the forecasts right now on a 10-year for year-end 23. I've got Nomura at 210, HSBC at 250, and an average of 350. Jim, does that make sense to you?
Look, I think Subhadra's got it right. I think in the beginning stages of this, there might be more risk for yields to actually rise. And I know the view right now is that we get a slowdown in the first half. This is where we're going to have all of the problems. So people call it, dip then rip or rip then dip in terms of how they want to think about the first half versus the second half of the year. The way that I see it, though, is that there are 4 important things that are going on in the first half of the year. Number one, inflation is peaking. Number two, the Fed's likely to stop hiking at some point in the first half of the year as well. The dollar is also likely to stabilize, and China is in the process of reopening. All of these things can be somewhat stimulative to the broader market because these are factors that were tightening financial conditions last year that are going to be a little bit easier as we move into the first half of the year. So if there is an opportunity here for us to see some upside surprises to a relatively pessimistic outlook, especially for the first half of the year, I think that's when we see it, is really in the first 6 months. So the starting valuation for bond yields today at 3.75%, when the Fed is likely to go to 5.25%, shows me that there's probably more upside risk in yield than there is downside risk in yield, unless something catastrophic happens and things really start to slow. So when I look at that and I compare it to spreads and what's happening in the markets, look, there's no wonder there's a lot of corporate issuance. First, it's the start of the year. The second is that many of these issuers want to get their bonds out at relatively low yield levels. They don't want to have to worry about it later on. So I think that's another aspect of things that we also have to factor in.
Hey, Jim, you mentioned China. We'll talk about that next. Jim Caron's going to stick with us alongside the brilliant Subhadra Rajappa. Coming up, China's rapid reopening facing pushback.
As China reopens their economy this year with no level of data that we used to get 5-10 years ago from the Chinese even, is an enormously concerning issue.
That conversation up next.
The global economy has never experienced anything like that. That level of uncertainty in the persona of one human being. We've seen it with the decision to do a complete 180-degree volte-face with the pandemic and zero COVID. We've seen it with $1 trillion off of market value of Chinese tech stocks because Xi Jinping decided that he was going to squeeze them. That level of uncertainty as China reopens their economy this year is an enormously concerning issue.
This is, without doubt, for so many people, the issue for the global economy this year. China's reopening, facing continuing challenges in 23. Surging COVID cases weighing on economic activity, with the country vowing to retaliate against other nations imposing travel restrictions. The foreign ministry saying the following: "We firmly oppose attempts to manipulate COVID prevention and control measures to achieve political goals. Some excessive measures are unacceptable." Damien Sasser at Bloomberg Intelligence joins us right now. Damien, we can talk about the data that was, or the data in 6 months' time off the back of the policy decisions made in the last couple of weeks. And I think the latter is more important than the former, so let's start there. Damien, what do you think this is going to look like 3 months from now, 6 months from now?
Okay, 3 and 6 months from now, obviously, I think that China growth is going to be coming in way higher than people initially projected. I'm talking, though, low 5s, for fiscal 2023. I think the real issue here is we had heard nothing official from Beijing regarding this let-it-rip approach that, toward COVID. And now all of a sudden you've got the foreign ministry kind of targeting Italy and the U.S. saying we don't want explicit restrictions on Chinese travelers, with no official data coming out, with no investigation as to the origins of COVID. How on earth is the U.S. going to allow this to happen? I just don't see it. And so, look, I think it's a little good cop, bad cop approach because the foreign ministry on one hand was saying that. And then on the other hand, you've got Gang basically saying, we're supporters of America. We like America. He's throwing free throws at Wizards games. He's riding around in Teslas with Elon Musk. Effusive praise for the U.S. So a little bit of a good cop, bad cop here, I think, Jonathan.
It's a change in rhetoric. Let's see if we get a change in policy. Damien, we've seen this movie before in the West, in Europe, in the United States. You remove restrictions, you reopen. And initially, you get some form of self-sanctioning by individuals across those countries because they pull back as sickness climbs, call-outs start to rise, and you have this period of softer economic growth, and then all of a sudden, Damien, boom. Any reason to believe it won't be exactly the same with China?
Not really. I mean, look, if you do look at some of the PMI data which came out over the break, the 30th, I mean, it was pretty weak, and it's going to get weaker. I mean, when we get the December data that comes in, if you look at activity data, which we're going to get next week, it's going to be weak. Retail sales, it's going to be weak. So, that's all kind of baked in. That's all kind of expected, but a lower base makes for higher returns going forward. So, if you were expecting 2.93% full-year growth in 2022, you're probably at 2.6, 2.7. If you're expecting 4.5 to 4.6, 4.7% in 2023, you're now closer to 5%, and I think that's where the market's headed.
Damien, where do you think the demand actually shows up? It's too easy to say you're going to get a boom in demand. Where's it going to be? Are these Chinese consumers spending at home, spending abroad? How do I play this story as an investor?
Well, it's not going to be abroad, right? I mean, we already see that the current account, we're calling for the current account surplus that China benefits so very much from to decline to something on the order of 1.5% of GDP in 2023. So you can't rely on exports to drive the growth, such as what we've seen throughout the better part of the last 2 years in China. I think there's going to be a pivot there. I think it's got to be domestic, but that means they've got to. We're going to get the total social financial data. We're going to see if there's any credit impulse in China whatsoever. They did not cut that 5-year LPR just before break, Jonathan. That's pretty big. That's pretty big weight on households, on medium-sized households, on the property sector most specifically.
Damien, we'll be talking about this for months and months, and no doubt for the whole year ahead. Damien, Happy New Year, buddy. It's good to see you. Damien Sasser there of Bloomberg Intelligence. Jim Kerr and Subhadra Rajappa back with us. Subhadra, first to you. How are you and the team over at SocGen thinking about this major issue through the year ahead?
I think it's going to be a tough call because, like the U.S., it's going to be a fits and starts progress on COVID. You're looking at a population that's about 3 to 4 times the size of the United States, with very low immunity levels to COVID. So for them to develop herd immunity is going to take a lot of time. And like Damien was pointing out, a lot of the Chinese economy right now depends on exports because the three sort of key sources of growth for China was the building property sector, infrastructure. Both of these have been kind of struggling, so they really have to rely on the third cog, which is exports. And for exports to be kind of steady, you need to see the COVID situation progress in a very steady fashion towards better level. And that's where I think I'm a little bit struggling to see how things are going to play out because we just really don't know. COVID in the U.S., we had several starts and stops before now we feel like we have some level of herd immunity and the service sector is back in full force. I think it's going to take a lot longer than people anticipate for that level of sort of steady progress in China.
That makes the supply side question complex too. Jim, how do you look at that particular side of things? Do we get more supply chain dislocations or supply chain relief off the back of what you're seeing develop in China?
So I think it's going to be a very bumpy path if we try to track COVID and relate it to what's going on with China. But I like what Damien said. Look, if we take a forecast out or a look out 6 months from today, I would argue that China's in a better position. I would argue that growth rates have accelerated. That's going to have positive knock-on effects to emerging markets. It's going to have positive knock-on effects to production of their goods and moving their goods around the world. But it's also going to create a lot of demand for certain commodities as well. So a China reopening can actually create an inflationary impulse as they actually start to reopen and demand, more goods for their for their production. So this is something that's going to create a lot of volatility going forward. And that's why I said, look, there are two very fat tails that are out there for this year. One is that we have a hard landing and certainly a slowdown. But the other fat tail is that we have this big boost from the second largest economy in the world that's trying to stimulate. They are stimulating. They're reopening. And that could actually create some positive ripple effects, unanticipated positive ripple effects, I may add, relative to what consensus expectations are. And that could have a dramatic impact on how asset prices, whether it's equity or fixed income, swings from one side to the other. So I think the way that we start to think about positioning this in a portfolio is really to try to take a balanced approach and really try to optimize risk-adjusted returns, because it's not going to be any one trade. It's not going to be any one thing to do right now today. It's really going to be about how we construct it, how we put the risks together, and how we try to balance those risks, because we have to be able to endure the volatility to stay invested over time to play this through. It's not going to be a very, very clear picture, which is why I think we're going to have a decent amount of volatility stemming from the policy side, inflation, of course, but also geopolitically with China.
Jim, what I just heard from you, though, was a challenge to the view that we get goods disinflation through 23. Is that a fair assessment of where you're at?
Yeah, I'm skeptical, right? So look, I'm a little worried about service sector inflation. Admittedly, that's where I am, tight labor markets. But goods, particularly on the energy side, particularly on the commodity side, in many ways, we just haven't developed the infrastructure to, create or get the commodities that we need, whether it's food prices, fertilizer, energy, oil, gas, whatever the case may be. So that could actually have an unintended surprise that goods prices do come down. I believe inflation is coming down, but it may not come down as much as people think. And my biggest fear is that inflation does come down, but it's not anchored, and people start to worry about it going back up starting late 2023 and into 2024. That's what I'm worried about the most.
Fascinating stuff. Two of the very best, and super grateful to open up 23 with both of you. Jim Karen there and Subhadra Japa. Coming up on this programme, the morning calls, and later, the S&P 500 down 20% after hitting its record high 1 year ago today. More on that with Citi's Stuart Kaiser around the opening bell. We are about 4 minutes away from the opening bell. Equities up 0.6% on the S&P, on the Nasdaq up almost 1 full percentage point. That's the price action. Here are some morning calls for you. First up, Truist upgrading PayPal to a buy, saying the company's well positioned for M&A due to its growing cash position. That stock is up by 3%. Next up, Wells Fargo upgrading Wynn Resorts to overweight, expecting China's policy pivot to accelerate the recovery in Macau. And finally, JP Morgan cutting its Tesla price target to 125, warning that recent price cuts and other incentives could lead to narrowing profit margins. That stock is sub 120 and it's down another 3% this morning. Coming up, Citigroup's Stuart Kaiser preparing for a make or break earnings season, expecting results to either confirm or deny the bear case for stocks. That conversation up next. Let's get 2023 started. About 20 seconds away from the opening bell this morning. Good morning. Equity futures going into the open positive by 0.5% on the S&P. On the Nasdaq right now, up 0.9% on the Russell, up 0.9% also. 12 months ago, we were at record highs, and now we are about 20% below those levels. There's your opening bell. 23 trading underway. Switch at the board and get to the bond market. I'll tell you where we were 12 months ago at the bond market. Yields are lower this morning by 14 basis points. Your 10-year 373. 12 months ago, your 10-year 163. Do the maths. Much higher 12 months later. In the FX market, big turnaround there too. 105.72 on euro dollar. We're negative 0.9%. German CPI, German disinflation. Is that a theme for the year ahead? What does that mean for ECB rate hikes? And WTI crude, 78.37. We're negative 2.35%. And the question we're all trying to answer, what on earth does China's reopening mean for that commodity market? And have the Chinese been stockpiling commodities enough to avoid maybe that boom in prices some people are expected? About 40 seconds into the session, equities up by 0.5% on the S&P. On the Nasdaq right now, up 8 or 0.9%. One stock to watch over the last month, including today as well this morning, Tesla. That stock negative by almost 5%, continuing its drop into the new year after fourth quarter deliveries missed estimates. Ed Ludlow joins us now for more. Morning, Ed.
Yeah, good morning, John, and Happy New Year to you. Tesla delivered 405,278 vehicles in the final 3 months of the year. That was below the average analyst estimate of around 421,000 compiled by Bloomberg, but it was also kind of a little bit higher than the most bearish case. The kind of main takeaway is that in 2022, Tesla did not meet its 50% average annual growth rate. And now if you look at the price target cuts along the sell side, which there are many to begin the year, a lot of them are pointing not just to demand concerns, but actually there is some concern out there that going forward, Tesla may never actually achieve that 50% annual growth rate. You've been talking on the show this morning, John, about it being exactly 1 year since the S&P 500 reached that record high. In that 12-month period, Tesla is down 70%. And you look at the trajectory for this stock. In fact, one of the other things that the sell side are talking about this morning in cutting price targets for Tesla, which is down now more than 5.5%, is that they see more competitive pressure and these macro issues leading to Tesla need to do something. What are the levers at their disposal? They can cut prices. They can use other levers to instigate demand, but all of that would have a pressure on the bottom line, and that makes the stock less attractive in their eyes.
That stock had a tough run in December through the whole of 2022. Another stock that had a difficult one was Apple. Last month, down about 12%. And I want to separate this out, demand, supply. On the supply side, we understand from a Foxconn representative over in China that iPhone City is back at 90% capacity. Good news, supply may be sorted, addressed. Let's talk about demand. Moments ago, we had a report from Nikkei that said Apple asked suppliers for fewer AirPod and watch components. What's happening on that side of the business, Ed?
Yeah, I think it's really interesting. December was the worst month for Apple going back to May of 2019. And you're right that there are pressures on both the supply and the demand side. The issue when it relates to Foxconn and Zhengzhou is that Apple could not supply enough of what was in demand, which was the higher end iPhone 14 Pro and Pro Max models. What they're seeing in management of supply chain is they are having issues with other products. You mentioned AirPods, though, which was a Nikkei report, right? What is not in demand is the lower end of the scale, the iPhone 14. There was less disruption there, but all that means is net, you have a lower average selling price, which is impactful to the bottom line as well as revenue. Don't just focus on unit sales, but think about revenue overall. What we've reported time and time again is that actually this transition away from reliance on China to areas like India and Vietnam for supply chain, it's not going to happen overnight, and they're still working out a lot of kinks. The net result is that units were down significantly overall for the year. But again, it's that they're not able to build enough of what's actually in demand, and that's the higher end iPhone 14 Pro handsets.
Ed, great to see you on the West Coast, buddy. Good to see you. Happy New Year. Ed Ludlow there over in San Francisco. Apple earnings, January 27th. Now, talking about difficult times, Southwest. We're told the airline is returning to its normal schedule as it processes refunds. That stock is down another 0.6%. Abby, what a tough ride.
Yeah,
passengers, never mind a company.
Absolutely, John. And Happy New Year to you. And I bet it's starting off a lot better than it would have had you been on book for one of those Southwest flights. Of course, it's a domestic airline, not affecting you. But tell that to the tens of thousands of people stranded, both passengers and crew. Nearly 16,000 flights were canceled between December 22nd and January 1st. To give you a sense of the magnitude for the company going beyond the blizzard, their technology, their outdated technology, American was the next with the most canceled at just 838. Now, of course, we are getting back to more normal travel now. You were mentioning that earlier in the pre-market, the stock had been higher. Today, about 34 flights have been canceled, about 170 delays, but still a really tough journey for sure. Bob Jordan, the CEO, said that there's almost no way to apologize enough. They are, of course, getting some money back to customers, reasonable expenses. But tell that to the bride, John, who missed her wedding. She had to postpone her wedding and then spent New Year's Eve alone in the airport, or to folks on Christmas who were almost arrested for trespassing in the airports that they were left stranded in. Tough times. These delays and cancellations will look worse because flights are almost back to pandemic levels. That's not true for the stock, though, John. The stock is almost down about 50% from its pre-pandemic high. And over the course of these delays, this debacle really, down about 9%.
Brutal. Absolutely brutal. Abby, thank you for that. Citi Stuart Kaiser looking ahead, gearing up for earnings season. That'll kick off unofficially, of course, with JP Morgan on the 13th, so that's next Friday. Fourth quarter S&P 500 earnings will be a key barometer for equity bears. Soft earnings and negative guidance are expected/required. of the bear case, leaving surprise to the upside from earnings, especially for tech. Stu joins us right now. Stuart, wonderful to catch up with you, sir, as always. Let's start there. Are you saying that we should play that, look to position for that opportunistically, that maybe you get that kind of upside surprise, particularly in tech?
Hey, good morning, John, and Happy New Year. Look, I think it's something that's on our radar. We probably want to give it a couple weeks here just to see how the year starts. I think it's just, though, a symptom of the broader malaise in the market, right, where the sell side consensus is extremely bearish, expecting negative earnings revisions and a disappointing earnings print. So that just kind of sets the bar much lower, and with the index now at 3850 instead of 4,000. It also kind of resets the bar a little bit lower. So I think when we think of risk reward around earnings, I think your downside risk is probably coming much more from the banks and the discretionary parts of the market. And frankly, your upside risk might come from tech, just because expectations are so low there that I think it's a pretty low bar for them to surprise on the positive side.
Stu, just when it comes to earnings season and the arc of earnings season, the banks go first, tech much later in the earnings season, then retail at the back end. What would you look for? Where would you look for signal for what you expect to see in the economy in the year ahead?
Well, I think you hit it right on the head there with J.P. Morgan starting off earnings in 2 weeks. I think the banks are probably going to speak very directly to the level of activity they're seeing in consumer spending and in lending, and I think that'll be much more of a macro takeaway from earnings. They'll come from the bank sector, and I think that's where we'll get kind of the clearest update on the economy. To your point, we don't get that retail data till probably till the middle of February, basically. So it's going to be first banks, and then we move on to the more idiosyncratic and kind of margin story from tech and healthcare.
Stu, how defensive do you think the banks are going to be in 23, given the shifts we've seen in that business model over the last 10 plus years?
I would expect them to be very conservative in their commentary. A lot of the CEOs have been on the tape the last month at various conferences and speaking engagements, also speaking with our analysts directly, and they've been, they've definitely guided down expectations, and I think they're trying to highlight the downside, kind of risk to the economy and to their numbers. So I would expect them to continue to do that. You might argue some of that was, also related to compensation in the bank sector as well. So just, kind of a lot of sort of negative news, and I think resetting of expectations coming from senior management across a lot of U.S. banks, and I think that probably continues.
Do you think it's odd, Stu, that when you listen to conversations on programs like this one, and maybe Bloomberg surveillance as well, that you see people lining up, almost itching to price a recovery to a recession that hasn't actually developed?
Yeah, I think that was the case in early December. I think the last 2 weeks have been quite a bit different. I think the Fed really, took the wind out of those sails, I think, right? To your point, I think in early December, the market was rallying. Folks were saying, the peak of inflation is behind us. It's going to be a shallow recession, and we kind of want to pre-trade that story. But, what the Fed did is it kind of drove a stake through the heart of that, because they essentially said, we're not comfortable with inflation, we don't like financial conditions where they are, and we're willing to sacrifice a recession to get inflation lower. So I do think that optimism was there, but I think it got eroded, pretty strongly in the middle of December, and that's why we've traded so poorly into year end.
Well, energy names didn't trade poorly, that's for sure, and you know that. That's where the outperformance, the leadership was through 2022. Energy on the S&P. That segment up 59%, Stu, last year. Is it too early, too premature to make calls on leadership for the year ahead?
Look, I think there's two questions embedded in that. Tactically speaking, you tend to see a very strong rotation out of market leaders very early in the year, and that's been about a 9 out of 10 years in the last 20 or 30 years. You've seen sort of leaders from the previous year underperform to start the year. In terms of, what's going to outperform, the next 3 to 6 months, I'd kind of say your guess is as good as mine at this point. In terms of energy specifically, I think there's a China global growth impulse, which you touched on, and then there's a depth of U.S. recession. And I think those two things are going to largely determine, whether the energy sector performs well. If you get a shallow U.S. recession and China's reopening in the background, I think you could argue for, continued commodity prices higher. If that recession in the U.S. looks like it's going to be deeper, I think that creates kind of a difficult sledding there for energy going forward. From my perspective, our view is to remain pretty cautious and pretty conservative here early in the year. Higher quality stocks, places you can kind of hide out, stocks with very clear kind of idiosyncratic, product or company specific stories that can weather kind of a recession to start the year is where we would point people to.
Stuart Kaiser, awesome, as always. Looking forward to working with you in the year ahead. Stuart Kaiser there. of Citi. Thank you, sir. Equities right now up 0.8% on the S&P, about 10 or 11 minutes into the session. On the Nasdaq, up by 1.2. Coming up, Blackstone's real estate trust getting a fresh $4 billion cash injection. That conversation with Blackstone president and COO John Gray sitting down with Sonali Basak up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Katrina Dudley, Franklin Templeton investment strategist. That conversation at 10 a.m. Eastern, 3 p.m. in London. This is Bloomberg.
To our worldwide audience on Bloomberg Television and on radio, I'm Sonali Basak. We're joined by Jonathan Gray, Blackstone's president and chief operating officer now. Jonathan, you're coming off this $4 billion investment from University of California Regents. A lot of this is for BREIT. It is for your Crown real estate fund, a lot of retail investors in it. $4 billion is much bigger, obviously, than the typical retail check. But this is coming after a wave of redemptions, as reported, over a period of time. So what is the $4 billion really accomplishing for you at the end of the day? Is it filling the hole from these investors, or is it giving you something new to do?
Well, Sonali, Happy New Year. I'll just start with a little bit of background here because this is a big win for us. It's a big win for BREIT. It's a big win for the University of California, who's making this investment. $4 billion of common stock into BREIT with a minimum effective hold period of 6 years. It is a massive affirmation of the quality of the portfolio we've constructed, of the values of the assets here, and the performance outlook. All of that, of course, is quite good for our investors. And this is something that came about really because of the news media telling this story on BREIT. In many cases, we disagreeing with that. And Jagdeep Boucher, the longtime CIO of the University of California's $150 billion investment fund, reached out and said, hey, is there something we can do together? We came up with a mutually beneficial structure, and then he and his team spent the last few weeks seeing real estate, looking at our portfolio, meeting with our portfolio company CEOs, understanding valuations, liquidity, and as a result, getting very comfortable in making this large-scale investment. So I think the biggest thing here is just a validation of BREIT, particularly given all the noise out there and some of the what we think of as incorrect analysis. In terms of what we do with the capital, well, we have a lot of options. We've obviously got a dislocated market out there, which creates opportunities. Some investors are seeking redemptions, although it's much smaller than I think the media has indicated. In fact, in December, after 8 weeks of negative press, we had just 3% of U.S. investors looking for redemptions, 5% of all of our investors, but some capital can go to that. We've got a lot of options, and it's nice to be in this position today, particularly after enduring some of this that we didn't enjoy, and now being able to clear the record and have a major investor so sophisticated come in at scale.
Hey, John, you know, one thing about this investment, as far as the terms go, they do have a preferred minimum return that they're going to be getting. It's something that's guaranteed to them. Why wouldn't another average investor look at this and say that's preferential treatment?
So the way to think about this transaction is they're actually coming in as a common shareholder at the BREIT level with this $4 billion fresh investment. They're taking that investment, and then we're taking $1 billion of our existing holdings and putting it in this strategic venture. It does give them a minimum return. It gives us some upside participation. But I think the things to keep in mind are, one, the validation I talked about, and two, just like in our large institutional funds, big investors do get differentiated consideration. So if you think about it, their investment here is $4 billion. A typical BREIT investor is $70,000. A typical investor can seek liquidity beginning a month after their investment. Here, effectively, it's 72 months after their investment. And so these things are very different fundamentally. And the additional considerations coming from Blackstone, they're actually paying the full fees that any of the traditional BREIT investors are inside the vehicle. So we think, as we said, a big affirmation and a real positive for BREIT.
You know, it's interesting because BREIT's own performance last year outstripped the market pretty meaningfully here, more than 8%, over 3 years, almost 15%. But the question here, too, I have is last year, hedges really helped the portfolio. Do those hedges start to subside in performance this year? And what is the thing that will bring you upward this year?
So I think the key when you look forward and ultimately is the performance of the assets. You're correct that we did get a big boost from the hedges we put in place. We hedged out the debt for 6.5 years smartly when rates were lower, when we were concerned about inflation. That gave us about $4 billion of value gains. It was very helpful. As the long end of the curve comes down, we won't have the tailwind from that, but we will have the tailwind from potentially lower long rates helping the value of this $130 billion portfolio. And over time, that should be quite beneficial. The other tailwinds here are the rents in place in the portfolio are about 20% below market. The market rents have continued to grow despite the economy slowing. They were up in this portfolio 10% in November. And then longer term, what we expect to see is a lot less new supply. You've seen it in the housing market. I think you'll see it in the logistics space as well. Those are our two big holdings, as you know, in BREIT. And less supply is key because ultimately the value of real estate is driven by supply and demand. And that gives us a lot of confidence as we look out over the horizon.
Do you see more opportunities? You had some meaningful sales last year. Do you think that there's more opportunity to sell into this market, whether it's because of market pricing or something else? Would it help you really build the value of this portfolio to do that?
Well, I think that's one of the tools. I would say the most liquidity in real estate today is in the rental housing space, multifamily apartments, and we have been selling some assets there. We'll probably continue to sell some. Other areas, there are opportunities. And I think one of the important things, Shonali, people think about BREIT as a real estate portfolio, but had we owned for sale housing or had we owned office buildings, it would have been much tougher. And so I think there'll be opportunities to sell in some sectors and hopefully some good opportunities to deploy capital also.
John, before I let you go, about 30 seconds or so here, victory lap for Blackstone. You guys were so early when you had predicted that interest rates would go much higher than anyone had thought. Joe Zeidel said as high as 5%. And that was when banks were still saying 3%. So where do you think they go this year? Do you think that the expectation of cuts makes sense?
So it's always dangerous getting into interest rate predictions, but what I would say is, given the fact that inflation is starting to come down, particularly in things like shipping costs, commodities, the labor market is cooling a bit, but is still too tight from the Fed's perspective. I do think the Fed will stop raising rates in the first half of the year, but my expectation would be they would hold rates at those levels through the balance of the year, even as the economy slows. I think the long end will stay inverted because people will think over time the Fed will cut and the natural rate of interest rates lower. But I think for the year, we'll get to this level somewhere around 5 or low 5s. The Fed's likely to hold there and the long end to be at a lower level given the expectation of a slower economy.
That's Blackstone's president and chief operating officer on the heels of a $4 billion deal. John Gray, thank you so much for your time. John?
Shonali, great work. Thank you. As always, we'll catch up with Shonali through the day on Bloomberg TV and radio. Just want to get your attention over to Tesla. That stock, session lows. We are down by more than 8 full percentage points. Let's squeeze in some sector price action as well. Here's Abby.
Well, here's something, John. We're actually looking at above average volume here. For a small gain at this point, the S&P 500 up about 0.2%. But what really stands out on the day, we are looking at last year's best sectors. Well, they're on bottom. That, of course, energy, consumer staples, healthcare and utilities. Discretionary has squeezed into there on that Tesla. Up top, we have communication services up 1.4%. Let's see whether or not the Santa Claus rally can continue. John, right now up about 0.6%, really being helped out out by some of the China tech and other tech names.
Abby, thank you. Equities doing okay. Tesla, not so much. We'll continue covering that story through the day on TV and radio and through the week right here on The Open. Up next, your trading diary, the path ahead into payrolls this Friday. 26 minutes into the session, 26 minutes into trading for 2023. Happy New Year. Good morning to you. Equities now totally unchanged after popping higher around the opening bout about 25 minutes ago, 26 minutes ago. We fade on the Nasdaq as well. That's the price action. Let's get you the trading diary. ISM manufacturing and US jobs data coming up on Wednesday. The Fed minutes at 2 p.m. Eastern time on the same day. More jobs data on Thursday, another round of jobless claims, plus service PMIs in the United States. And finally, the big one to round out the week is the payrolls report on Friday from New York City. Thank you for choosing Bloomberg TV. It's good to be back at a seat. Happy New Year to you all. This was the countdown to the open. This is Bloomberg TV.